will stick straight into it with the legendary entry helper. I'm telling you guys, don't underestimate this thing. It seems simple, but it's actually insanely crazy. So I'll give you like a little backstory of what is going to happen. So the entry helper background. The theory behind that came to us when we implanting a similar approach in a project, because you know, like JP and myself, we're working on multiple stuffs for a long time in the back with all kinds of approaches, and one approach we did was very similar to approach that Rentech does. Maybe a few of you know what Rentech is. It's Renaissance Technologies led by Jim Simons, one of the best, if not the best performing hedge funds like a while ago. Now not so good anymore because Jim Simons turns really old. He recently went back off his CEO place as well, so he retired. But those guys in Rentech, they arguably are one of the best hedge funds performing wise in the history. Okay, so that was a secretive hedge fund which used a form of machine learning to make trading decisions based, and now think about that closely, based on efficiencies in the market which stray away from the equilibrium. So you heard the word efficiencies or imbalances a lot, and these are just inefficiencies or imbalances in the market. You know already what it is, and Walker also covered it in depth for you today as well. So what they wanted to see though is that price is straying away from the equilibrium. So what is the equilibrium? Just in very short case. So if you have a push in here and here, like again, let's say the imbalances would be from here to here, the equilibrium would be exactly the 50%. That's why you see sometimes price doesn't fill the imbalance perfectly. It comes and whatever and taps the 50% of the imbalance, and then it goes lower whatsoever. That's just equilibrium of price action or these imbalances. That's very, very important for later on, because again, imbalances, they don't need to fill properly all the time. Sometimes it's perfectly enough that they fill 50%. It's rare. You cannot trade them because of course you expect the full mitigation in here. That's obviously the better play, but you need to be aware that sometimes 50% or the equilibrium is enough. Okay, and I even gave you an example, I think on Friday at night, the last one we had in GJ, where, for example, the London close mitigated the equilibrium of the imbalance. So the equilibrium will always be the 50%, okay? So hence, we added this so-called equilibrium into a trading tool to simplify the approach to trading certain inefficiencies in the market, which we will call on from now on the entry helper. But again, remember, we should not look only at the entry helper and then just trade the entry helper. That's not how we used to do it. No, that's why we spend so much time first on giving you the overall chart mastery on a basic level so far, and now we're combining the entry helper on top of that to make it even more clean, or for an additional confluence of events. So the entry helper was simply formulated by looking at the law of average movement on price. It was observed looking at an experiment of the sum of least squares and ordinary least squares. Price movement pretty much. It was noted that price would not stray away from these projected averages, but and in times could touch and bounce with these averages in specific scenarios for high confirmation trades. Or in simple terms, it's just lit. You don't need to understand that so far, right? It's just we show you how to use it. And of course, it will be part of it. But to show you exactly what Rentech did, or what pretty much Jim Simons did, which is the founder and CEO of Rentech, he uses quantitative analysis to decide which trades to enter based on market, again, inefficiencies. And he said, for example, inefficient market theory is correct in that there are no gross inefficiencies. But we look at anomalies that may be small in size and brief in time. We make our forecast. Then shortly thereafter, we reevaluate the situation and revise our forecast and our portfolio. We do this all day long. They traded like so many times, literally every single day, and they pretty much always are in and out of the markets consistently. So that they're not swing traders, they actually were almost like frequency traders and used these inefficiencies. So we are dependent on activity to make money, pretty much, he said. So in simple though, an efficiency or an efficient market is one that does not succeed in incorporating all available information into a true reflection of an asset's fair price. Maybe it sounds a little bit whatever, too much for you, don't matter, right? So market inefficiencies exist due to information, right, and transaction costs, market psychology, and human emotions. That's pretty much all the reasons we gave you earlier in a detailed way anyways, but they used it similar, just they didn't have the understanding, they just thought it's part of all these inefficiencies. And as a result, some assets may be over or undervalued in the market, creating opportunities for pretty much their profits. But again, we have a different approach, but you see how actually few different points of views melt together in this. So what they did pretty much, and how did they trade these market inefficiencies, right? Remember that if the market is inefficient, it is pretty much driving away from the so-called equilibrium, and therefore when they see market inefficiencies playing out, they either chose to trade away from the equilibrium to trade back towards those pretty much divergent converting market states, or they traded into the equilibrium. Okay, but again, you all probably be like, what in the fuck is going on here? Like, what is he trying to tell us with that? So no worries, that's exactly whatever these institutions, hedge funds love to do. They just make it sound like completely overcomplicated and whatever. But in reality, if you understand what they're actually trying to do and how these markets work with the delivery inefficiencies, we can simulate the same exact approach with quote-unquote retail indicators. It's actually very, very simple. And again, we take advantage of the knowledge that retail strategies give or need to work at some points, and that's why we can use some sort of retail pretty much indicators just to modify them pretty good and making the same exact result as pretty much Rentec did with the inefficiencies of price, right? And of course, like the overall equilibrium. So how we doing it? We just needed something which represents price, and we needed something that represents the equilibrium. So that's how we ended up with. It will look something like this in here. Pretty easy and clean stuff, isn't it? So what is going on here? So it will be on the bottom of this chart, right? And of course, it will be given to you at the end, right? So what is going on here? It's made out of 3 components, very easy stuff. So first thing is the static equilibrium. That will always be in overall where the equilibrium of price is on a fixed basis, okay? Then of course, we will have the liquidity equilibrium or the liquid equilibrium, because again, we need something that simulates price on an equilibrium basis. So we just took a modified equilibrium line, okay? So that's normal indicator stuff you can use. And then last but not least, we need the price action simulated in this indicator as well. But what in the hell is going on here? So how the hell do we even take advantage of that shit, right? So of course, we will provide you with it, and of course we show you how to use it. It's a clean, it definitely looks clean, it's not even overcomplicated whatsoever, and it just adds a lot more clarity. How? Of course we will show you. And again, it is a confluence and should not be traded alone. And we will use it for LETs and EDMs, and also to confirm cup trades and entry opportunities. It will be definitely very, very good. Okay? It's definitely not only the other side. Show money, what the hell? So pretty much, what's liquidity equilibrium touch means? Okay, so that's the LET. The LET is a shortcut for liquid equilibrium touch. Okay? We will trade crossovers. Definitely not. Definitely not. So what we are going to do is the LET characteristics. So the LET uses pretty much the entry helper. So what are we going to do? You already understand if we have a momentum price changes in price. We have our, let's say this is the inducement. We have our breakout structure, right? So what are we looking for? We're looking for mitigations in here, right? So now we understood, okay, if you can simulate like bigger times approaches, which is price actually touches or pretty much fills the equilibrium of price, we have our price point and we have our liquidity point. The only thing we will use that is if equilibrium points upwards and price actually touches the equilibrium. So we completely ignore the whole rest. We're only interested if actually, again, the price touches the equilibrium for additional confirmation. Okay, sounds simple. It's fucking powerful. You will be surprised. And again, you probably underestimate it, of course, right? But yeah, we did the same thing. We thought it's too easy, but it's definitely not. So how we will use it later, again, we can use it on for shorts and longs, of course. Again, maybe you don't like it now. You will definitely love it after. I can promise you that one. Just a quick one. Make it more reliable again. Look at the equilibrium line pointing upwards. But again, if it points downwards, the equilibrium might not be ready to reverse. And then the whole thing is most likely gonna fail. It's not so clean. If it actually points upwards already, again, it's just more cleaner and makes the whole overall picture more reliable to use. Okay, again, same thing always. We're using our same approaches, using our break-up structure. We want our mitigation, and this confirms the last final push and makes the whole thing, again, maybe you don't like it now, you will love it later. It makes it so much more reliable and will keep you out of a lot better situations. Okay,